Ever feel like when people start talking finance, it's a whole different language?
Yeah.
Like you need subtitles just to understand your own money.
Haha. I know what you mean. It can definitely feel that way sometimes.
Right. That's exactly why we're doing this deep dive. We're going to decode this finance and economics course you sent in.
Sounds good to me. Let's break it down.
Because, honestly, who has time to become Wall Street gurus, right?
Not me.
Today is about giving you the knowledge to talk about investments and interest rates without feeling lost. And maybe, just maybe, spot a good opportunity or two.
Sounds like a plan.
Ready to decode the world of money.
Let's do it.
All right, so we got to start with the big dogs, right?
Mm.
The federal banks, I know, sounds super exciting.
Riveting.
But here's the thing. What they do, what they decide, it affects you directly. Your wallet feels it.
Yeah, it's true. It's easy to forget they're there, but then you try to buy a house or something.
Exactly. Take the Federal Reserve. They're not just, like, playing with interest rates for fun.
Oh no, their decisions have a ripple effect, and those ripples reach everything. How much you pay for that mortgage, whether businesses feel good about expanding.
Right. The source even mentioned how the Fed raised interest rates recently, and bam, mortgage rates jumped a full percentage point.
Oof, yeah. Imagine trying to buy a house now.
It's a big deal.
Yeah.
And it's not just mortgages, right? When interest rates are low, like back in 2020.
Everybody wants to borrow money, businesses are investing, it feels like the economy's got a rocket booster strapped on.
But there's always a but.
There's always a flip side. People get a little too comfortable, maybe take on more debt than they should.
And that's when we start hearing that scary word, inflation.
Everyone's least favorite topic.
It's more than just like, my groceries costed more this year.
Right. Think of it this way. It's about how much your money can actually buy over time. Like, if a loaf of bread was $2 last year and it's $2.50 now, your money is literally buying you less.
That's a really good way to put it. It's like your money is slowly shrinking.
Exactly. It's that shrinking power that's inflation in action.
And this source brought up something pretty interesting. They said that governments might not always be totally honest about the real inflation rate.
Ooh, yeah, that's always a little unsettling to think about. Makes you wonder what's really going on behind the curtain.
Right. It definitely makes you think. And it's so easy to confuse inflation with devaluation. But they're not the same thing, are they?
Not at all. Think of it like this. Devaluation is when one currency, like the US dollar, starts losing value compared to another, like the euro.
Oh, so it's less about what the money can buy and more about its power compared to other currencies.
Exactly.
This source had a really interesting way to explain this whole currency thing, they said, to imagine banknotes as checks that used to be backed by actual gold. So when a country prints more money without the gold to back it up, it's like writing bad checks, devaluing the currency.
That is a great analogy, and it makes the stakes really clear.
Right, because if nobody trusts those checks anymore.
The whole system starts to crumble. We've seen extreme examples of this, like what happened in Zimbabwe.
All right.
They printed so much money without anything real backing it up that their currency went through hyperinflation, became practically worthless. Shows you just how important a stable, well-managed money supply really is.
So speaking of managing money, let's talk about putting your money to work, as they say. Investments. Now, I know this is where some people get intimidated.
It can feel like a whole other language sometimes, for sure.
But this source actually broke it down really well. So first up, fixed income.
Fixed income is all about predictability. You lend out your money, whether it's through bonds or maybe buying a rental property, and the interest rate you're getting, that's decided up front.
So you know exactly what you're getting, right?
Exactly. Lower returns typically, but lower risk too.
So it's like the tortoise in the race, slow and steady.
That's a good way to put it. Then you've got the hair variable income. This is where things get a little more interesting.
And a little more unpredictable, right?
Yeah, exactly. Could be more profitable for sure, but also riskier. We're talking stocks, ETFs, certain types of funds. With variable income, your returns, they fluctuate. You could hit it big, or you could see some losses. It's all a balancing act.
It's about finding that right balance between risk and how much you could potentially make.
Exactly. Figuring out what you're comfortable with is key.
Which brings us to, I think, one of the biggest names in the game.
Yeah.
The S&P 500. We hear it all the time, but what does it actually even mean?
It's like the who's who of the company world. Essentially, it tracks 500 of the biggest U.S. companies. Think of it as a snapshot of how the overall U.S. economy is doing.
So instead of putting all your eggs in one basket, you're betting on the whole basket case of the American economy.
You could say that, but that's the beauty of it. It's diversification. Now, this source had a really interesting example using Tesla. Remember a few years back when their stock was shooting through the roof?
Who doesn't?
Had you invested in just Tesla back then, you'd probably be sipping lemonade on a yacht right now. But with something like the S&P 500, those gains get spread across all 500 companies.
So less of a chance to get super rich quick, but also less of a chance to lose it all in one go.
Exactly. Now, it's important to remember the current economic climate, too. The source mentioned that with interest rates rising, it often casts a bit of a shadow on the stock market's performance. That includes the S&P 500.
It's like the tide going out. It affects all the boats.
A very accurate analogy. Now, this next part always trips me up. ETFs versus index funds. They both let you invest in indexes like the S&P 500, so what's the difference?
Right. They seem kind of similar.
They do. It's all about how they work that sets them apart. ETFs, you buy and sell them just like stocks throughout the day. You pay commissions each time, and if you make a profit, those gains are taxed.
Got it. So more of an active trading type thing.
Right. Index funds, on the other hand, you usually buy those through a brokerage. Often lower fees, and you might get some tax advantages, especially if you reinvest what you earn.
So it's really about figuring out what works best for you, your goals, and how you like to invest. Speaking of which, let's talk about the stock market. The source actually used a really great analogy to explain it. They compared it to a racetrack.
Ah, yes, the racetrack analogy. That one always helps to visualize things.
So let's say we're at the races. How does this whole thing work?
Well, each horse, that represents a company, right? How well they're doing, if they're winning, losing, heck, even if they stumble, all of that affects how much they're worth, just like a company's performance affects its stock price.
So you're not just betting on the fastest horse, you're trying to predict which horse is going to have the best performance overall.
Exactly. And just like at the real races, those odds, they change constantly. Stock prices are always fluctuating based on, well, everything. How the company's doing, what's happening in their industry, even global events can have an impact. And of course, good old investor sentiment.
So it's like a giant, complicated puzzle with real money at stake. And speaking of stakes, I think it's really important to differentiate between investing and trading.
Yeah.
Those two terms get thrown around almost interchangeably, but they're not the same thing, are they?
Not at all. And understanding the difference is huge. Think of investing like a marathon. It's about long-term growth, riding out the market's ups and downs, because over time, things generally trend upwards.
So patience is key.
Exactly. Trading, on the other hand, that's more like a series of sprints. You need to think fast, be agile, and have a high tolerance for risk. You're trying to time those short-term price swings, buy low, sell high, but it demands a lot more time, skill, and let's be honest, a strong stomach.
Because those swings can be intense. The source even mentioned how emotionally draining trading can be, always watching the ticker, riding those highs and lows.
It's not for everyone, that's for sure. And it can lead to impulsive decisions, acting on emotion rather than logic.
Speaking of emotional roller coasters, let's talk about those market dips that make everyone nervous: market corrections and bear markets.
Those two words strike fear in the hearts of many investors.
It's true, but understanding what they actually mean, what causes them, that's key to writing them out, right?
Absolutely. It's funny, we use those terms corrections, bear markets, almost like it's just a normal Tuesday.
Right. But they're actually huge deals.
Absolutely. They reflect pretty big shifts in how the market's feeling, and those shifts, they affect everybody who's got money in the game.
The source did a good job, though, I thought, of breaking down the difference between those two terms. Super helpful, because I think everyone's looked at their portfolio and been like, wait, is this a correction? Is this a bear market? What's happening?
For sure. So market correction. Think of it like you're swimming in a pool, everything's fine, and then suddenly someone just jumps in, big splash, right? Get that little jolt. That's kind of what a market correction is.
I like that. So it's a dip, but it's temporary, right?
Exactly. Usually we're talking a drop of 10% or more, but it's from where the market was, like recently. And all sorts of things can trigger it.
Like if the Fed comes out and suddenly raises interest rates again.
Exactly. It could be something like that. Could just be like a bit of global uncertainty. Investors get spooked easily.
So they all jump in the pool at once.
Precisely. Now, here's the thing about corrections. They're normal. In a healthy market, you're going to get corrections. It's like hitting the reset button. Prices adjust, and savvy investors, they might see those as buying opportunities.
So don't freak out. Don't sell everything the second you see the word correction.
Not at all. Keep your cool, revisit your strategy. Maybe there's a sale happening on something you've had your eye on.
Okay, that makes sense. But then there are bear markets, and those sound a lot scarier.
They are a different beast altogether. If a correction is a quick dip in the pool, a bear market. That's like diving headfirst into ice water. It's a loom decline, usually a 20% drop or more, and it can last for months, even years.
Ouch. Yeah, that's a long time to be holding your breath. What causes something that intense?
Could be anything, honestly. A recession, some huge event on the world stage, maybe an asset bubble that's finally burst. The source even mentioned high inflation, like what we've got going on now, can be a warning sign.
Because if inflation's eating away at everyone's buying power, businesses are making less, and the market reflects that.
It's all connected, and bear markets, they're tough because they really test investors. It's so easy to panic and make a bad call.
Like selling off everything
Right.
at a loss, right? And then who knows, maybe the market rebounds and you missed out because you panicked.
That's the worst feeling. That's why having a plan is so important. Figure out your risk tolerance before you need to know it. And for goodness sake, don't check your portfolio every 5 minutes.
Remember that marathon mindset we were talking about earlier?
Exactly. Now, nobody can tell you exactly when a bear market's going to hit, but there are some signs to watch out for. The economy might start to slow down, investors might get skittish, and if you're looking at stock charts, you might see those lower highs and lower lows.
So like playing detective, looking for clues.
Exactly. And once you spot those clues, it's not about panicking, it's about positioning yourself. Maybe adjust your portfolio a bit, diversify, or maybe just hold tight and wait it out.
This is probably where having a financial advisor would come in handy, right? Someone who's been through this before.
Oh, absolutely. They can be invaluable during those turbulent times. Because remember, a bear market is still part of the market cycle. Spring always follows winter, right? A bear market will eventually give way to a bull market, which means growth and optimism.
So you weather the storm, and then you come out stronger on the other side.
You got it. Now, speaking of weathering financial storms, there's another tool that can be helpful during times like that: hedge funds.
Hedge funds. Okay, those always sounded to me like something only billionaires talked about.
Well, it's true. They tend to cater to, let's say, a wealthier clientele, but the idea itself isn't as complicated as it sounds. Basically, a hedge fund is just an investment fund that uses, shall we say, creative strategies to try to make money, no matter what the market's doing.
So like they've got a secret playbook for how to win even when everyone else is losing money.
I wouldn't say secret, but they do use tactics that are more complex things like short selling, leverage, derivatives, all designed to make a profit whether the market's up or down.
Okay, you lost me a little bit of derivatives.
Fair enough. Think of it this way. Imagine a regular investment fund is like a big ship. It goes where the current takes it. A hedge fund is more like a speedboat. It can zig and zag, even go against the tide to try to reach its destination.
So they're adaptable, able to react quickly.
Precisely. But also, just like with a speedboat, there's more risk involved. Hedge funds can be expensive to get into, and they don't always outperform the market despite what they might promise.
Right, so it's not a guaranteed win, just a different approach.
Exactly. And speaking of different approaches, let's get back to index funds for a minute. We were talking about those earlier, specifically the ones that track things like the S&P 500.
Right, because you can actually choose how those funds track the index, right?
You got it. And that's where weighting methodologies come in.
Okay, that sounds complicated.
It's not as bad as it sounds. Basically, it's how much importance, how much weight each company in the index fund has in the overall portfolio.
So going back to our racetrack, it's like deciding how much each horse gets to pull the carriage.
Exactly. Love the analogy. Now, two of the most common ways to do this are market cap weighting and equal weighting. Market cap is the most popular one, companies with a bigger market capitalization, which basically means the bigger, more valuable companies.
Yeah.
They make up a larger percentage of the fund.
So the biggest, strongest horse gets to do most of the pulling.
You got it. This approach, it usually favors those well-established companies, and it tends to follow the overall index's performance pretty closely. Now, equal weighting. That's where every company, no matter how big or small, gets an equal share of the fund.
So even the littlest horse gets an equal say in pulling the carriage.
Exactly. This way, you get broader diversification, and you might see higher returns, especially if those smaller companies outperform the bigger ones.
So you're kind of choosing between a team of Clydesdales or a mix of different breeds, each with their own strengths.
Love it. It all depends on what your goals are, how much risk you're comfortable with, and whether you believe in the little guy or the big established players.
It's amazing how much depth there is to investing. Even with something like index funds, there's still so much to consider.
That's what makes it interesting. Always something new to learn, new strategies to try. The financial market is full of possibilities.
Speaking of possibilities, This whole deep dive has got me thinking. There's a lot I don't know about this stuff.
That's the first step, right? Recognizing there's always more to learn.
So we've talked about these market cycles, bear markets, all these factors that influence things. What does this all mean for the future of investing? Is there some crystal ball we can look into?
If only. Predicting the future of the market is, well, impossible, but there are things we can look at, trends we can analyze, and history has a way of, sort of rhyming.
Let's put our detective hats on again and see if we can find some clues.
On in. Now, one thing we know for sure is that interest rates are going to play a big role. We've talked about how the Fed's decisions have a ripple effect, right?
And with inflation still sticking around, everyone's wondering what they're going to do next.
The million-dollar question. Some analysts are even saying they think there's going to be another interest rate hike in the next few months, and if that happens, well, it could really rain on the stock market's parade for a while.
Yeah. So anyone looking to make a quick buck in the stock market, they might want to hold their horses.
It's always a gamble, right? But this is why it's crucial to remember investing. It's a long game. Getting caught up in every little dip and spike, that's a recipe for emotional decisions and often missed opportunities.
Tune out the noise, focus on your goals.
Exactly. Now, another piece of the puzzle, the whole geopolitical landscape. The world's getting more interconnected all the time, which means events on the other side of the globe, they can affect the market too.
The source mentioned that conflict that's going on overseas, how it could impact energy prices, supply chains.
And that's just one example. This kind of global uncertainty, it makes things volatile, hard to predict what's going to happen in the short term, but it also highlights how important it is to diversify your investments.
Right, so even if one area is having a tough time, the rest of your portfolio can pick up the slack.
Exactly. Now, while geopolitics and the economy, that's one side of the coin, technology, that's another force that's shaping the future of investing.
It's always changing, right? Disrupting industries, creating whole new ways to invest.
And the source really honed in on artificial intelligence. That's a field with huge potential to change everything, from healthcare to, well, finance itself.
Imagine the investment opportunities there.
It's definitely exciting, but like with anything new, a little healthy skepticism is a good thing. Do your research, don't just buy into the hype.
Not every shiny new thing is going to be the next Google.
Exactly. Now we've got interest rates, geopolitics, technology. The last piece of this puzzle we need to talk about is, well, us, investors.
You mean like how we're feeling about the market, our mood?
That's a big part of it, actually.
Yeah.
Investor sentiment, as intangible as it seems, it plays a huge role in how the market moves. The source even mentioned something called animal spirits driving market behavior, which I love.
Animal spirits. Okay, so we're not always rational about this.
Not always, no. It's a term that comes from economics, basically saying that our instincts, confidence, fear, optimism, pessimism, all of those emotions, they influence our financial decisions too.
So if everyone's feeling good, confident, the market tends to go up. And if everyone's scared, it goes down.
It's a self-fulfilling prophecy sometimes, understanding how all of this works together. The interest rates, what's happening in the world, technology, and even our own gut feelings as investors, it's key to navigating the market.
It's like putting a giant puzzle together, and we need all the pieces.
Exactly. We might not have all the answers, but even just having this basic understanding, that's what empowers us to make informed choices.
Be adaptable, be informed, and maybe channel your inner detective a little bit.
I like it. Now, before we get to our final thoughts, is there anything that's really stood out to you during this deep dive? Any questions bubbling up?
You know, one thing that keeps coming back to me is that whole devaluation thing we were talking about. It's like there's this whole other financial system out there running parallel to the one we've been discussing. I'm talking about cryptocurrency.
Ah, yes, the Wild West of finance.
That's exactly what it feels like. You've got Bitcoin and all these others existing totally outside of those traditional systems. No central banks, no governments controlling things.
It's a whole new world of risk and reward. And the thing about crypto is, because it's decentralized, that value, totally driven by supply and demand.
Which makes it volatile. Remember back when Bitcoin went up to, what was it, almost $70,000?
And then crashed down to $15,000?
Exactly. That's a wild ride.
It just shows you, as appealing as those potential returns are, the downside can be just as dramatic.
So where does crypto fit into everything we've been talking about? Investing versus trading. Is it like digital gold, something to hold on to long term? Or is it more of a get-rich-quick kind of deal?
It's the question, isn't it? And the answer is it depends. Some people, they see Bitcoin as a hedge against inflation, like a digital version of gold, because there's a limited supply.
Right, because gold is valuable, in part because it's scarce.
Exactly. But then others, they're in it for the short game, the potential for quick gains, even with the risk that comes with it.
That makes sense. This source we were talking about earlier, they made a really interesting point about how all currencies, in the end, they have to be backed by something, right? Some intrinsic value.
Right.
So with something like Bitcoin, what is that? There's no government, no physical asset like gold.
It's the question that has everyone debating, right?
Yeah.
The value of Bitcoin, it comes from its technology, the blockchain, it comes from that limited supply we talked about, but also, honestly, it comes down to belief. People believing in its potential.
So you gotta have faith.
Maybe a little, which is why it's so important to be cautious. Do your research, understand what you're getting into, because it is risky.
That's good advice for any kind of investing, really. As we wrap up here, I'm kind of amazed by how much ground we've covered.
Me too. We went from the Fed to ETFs, talked about bear markets, and even dove into the world of crypto.
It's been a journey.
But that's what this is all about, right? Giving you the tools, the knowledge to navigate this world.
Because at the end of the day, investing in your financial knowledge, that's one of the smartest moves you can make.
It really is. The more you know, the better decisions you can make, and the better equipped you are to reach your financial goals.
So thank you to our amazing expert for joining us on this deep dive.
My pleasure. It was great to chat about all of this with you.
And to all of you listening, thank you for being here. We hope you learned something new and that you feel a little more confident about navigating the world of finance. Until next time, happy investing.